Most beginners focus on what to invest in. ETFs, stocks, all of that. But almost no one talks about where your money should actually go first, what accounts you actually should be investing in. And that decision can cost you thousands in taxes over time if you are not careful. Which is why in this video, I'm going to show you the number one account that I personally use and love, and why I believe most beginners should open this account before a regular brokerage account, like a Robinhood, for example. So if you are new here, my name is Jocelyn, and I'm a money coach that teaches women how to invest their first $100 in the stock market and grow their money with clarity, confidence, and education, okay? I'm a financial educator where education comes first, strategy and execution comes immediately after, okay? So let's talk about the cost of choosing the wrong account. So, as I mentioned, I highlighted Robinhood. You likely have heard of Robinhood. That is a taxable account. And if you invest in a taxable account, a taxable brokerage account, you are being taxed on everything that happens in that account, every dividend that you earn, any kind of growth that's happening in the account, any kind of withdrawals that you're taking from the account is being taxed, okay? And the goal with investing for me, for you as a beginner, is to earn as much money as possible and get taxed as little as possible. But because of social media and online and marketing, we hear about these accounts like the Acorns and the Robinhoods, and we think that's the first step, but that should not be the first step. There's actually two types of accounts you need to consider, especially if you're starting out, because the growth of your money, the growth of these accounts matters more than anything. So let's simplify it and highlight these two different directions and these two types of accounts. The first account is a taxable account. We just talked about that. That's a regular brokerage account. You can find it again at the Robinhoods, the Acorns, Fidelity offers them, Vanguard offers them. Yeah, they're great. They offer you the most flexibility, which means that you don't have to wait until 59 and 60 like a lot of these other retirement style accounts happen. But again, people don't think about how you're being taxed on the growth, on the dividends, on the withdrawals. All of that matters. Any kind of activity that's happening in that account is taxable. That's why it's called a taxable account, okay? As a beginner, as your money coach, I do not recommend you start there. Do I recommend you have one? Yes, but that shouldn't be the first account you open. You should be focused on non-taxable accounts, non-taxed accounts, which are our 401ks, our 403bs, and even IRAs. A lot of people think they know what an IRA is, but they don't. An IRA stands for an individual retirement account, okay? And there are two types of IRAs. There's a Roth IRA and there's a traditional IRA. And for the purpose of this video, I'm going to focus on Roth IRAs because that's what I have. Most of my clients make less than $150,000, which is the income limit you can have to invest in a Roth IRA. And the reason that I love Roth IRAs is that they allow your money to grow tax-free, okay? Y'all know my goal for you, my goal for me is to make as much money investing and pay as little as taxes as possible. And with the Roth IRA, you can do that. Now, again, there are some income limits, some contribution limits, all of that. We're not gonna talk about that on this video. We're just gonna talk about the beauty of allowing your money to grow tax-free. So let's say you are investing, I don't know, $10,000 every single month in a Roth IRA. If you leave that money in there and don't touch it, imagine the growth that you gain. Again, the stock market historically returns between 7 and 10% annually every single year. So your money has an opportunity to grow by 7 and 10%. There have been years that my account has grown by 15%, by 20%, and there's been moments when my portfolio has grown by 5%. But the reality is, what I put in always ends up being more than what I will eventually pull out. Now, it is important for you to know that you cannot pull out your dividends. You cannot pull out any kind of growth that's happening in the account. But as I mentioned in the very first video of this series, you can pull out your contributions from this account in particular, okay? Not from your 401ks and 403bs. You will be taxed on that. But if you need to pull out your contributions from your Roth IRA, for example, you can do that and not pay taxes. Do I recommend that? No, only in dire needs. Let's say you got laid off from a job. Let's say life is lifing, okay? But it's not for your nails. It's not for your hair. It's not for you to live your life. That's what other high-yield savings accounts are for. I have a whole video on high-yield savings accounts. I'll pop that up on the screen. But a Roth IRA is a non-taxable account, and it allows your money to grow tax-free year after year. And the beauty of investing is compounding interest, y'all. That's your interest earning interest on its interest. So if you put $100 in there and the stock market returned around 10%, that means your ending balance is 110. Let's say the next year you started with that 110 and the stock market returned another 10%, your new balance is 121. You do nothing to do this. That's just the money you earn as being an investor. And that's why I'm a huge fan of investing, because your savings accounts aren't generating these kind of returns, okay? Your checking account ain't paying you nada, okay? That money, whatever you put in there is going to be in there. It's safe, but your money's not growing. And if we think about inflation, if we think about our futures, the goal is to not work for the rest of our lives. The goal is to be able to live on our wealth, live on the smart money moves that we make. And that is why I'm a huge fan of choosing the right accounts to invest in and investing as early as you can. Not wait until you're 40 and 50 and stuff like that, because ultimately what you want is that money to grow over time so that it shortens the amount of time that you work. So why Roth IRAs are smarter, I already talked about that tax-free growth, but they also allow you to invest in all types of things. I just talked about in my most recent video the beauty of the beauty of exchange traded funds, which is short for ETFs. You can invest in those. You can invest in stocks, you can invest in gold, you can invest in all kind of stuff. But again, as a beginner, I recommend you start with exchange traded funds, baby, because they're easy to understand and you see it in your daily life, okay? It's also giving you long-term advantage. If you leave that money alone, put it in that Roth IRA and let it do its thing, okay? Every year, that account is going to grow. Every month, that account is going to grow. But if you try to pull the money out prematurely, it's not going to have the opportunity to grow as much. So I don't want you to think about Roth IRA as a savings account. You have the account and you invest in the account. And then you leave that money alone, baby. Do not touch that money unless you absolutely need it. That should not be the first place you go, you know? And then as I mentioned, the beauty of all of these IRAs is that they give you flexibility to pull out your money, pull out your contributions, okay? Only your contributions as you need to. Do I want you to do that? No. I want you to leave that money in there so that compound interest can do its thing, so that you can get the max amount of dividends from these companies that pay them, which is when you get a small percentage of whatever the company's earnings are, you usually get that quarterly. And that's the beauty of investing too. You get the compounding interest, and on certain occasions, depending on if the company pays dividends, you get quarterly dividends, okay? Some companies pay annual dividends, some companies pay monthly dividends, but that's the beauty of investing, you know? A Roth IRA essentially lets your money grow without taxes, freely, okay? So it's not eating into your returns. It's not eating into the money and the growth that you're getting, okay? It's a great way to leave your money alone and let it do its thing, okay? But what most people don't realize, most women don't realize, is that if you're planning to start investing soon, the decision matters now more than ever, y'all. Now more than ever. As I mentioned, opening the account is the first step. Actually investing in the account is really what matters. Otherwise, you just have a glorified savings account. And I need you to use a high yield savings account if you're trying to save, okay? We're trying to grow our money. We're trying to invest our money. Investing is your money growing on your behalf without you having to work for it. And that is where a lot of women freeze. And I completely understand, you know, because they have information overload. They're afraid of doing it wrong, investing in the wrong thing. They have analysis paralysis. So they get so overwhelmed that they don't make any decisions. And each month you put it off, each year you put it off, it's costing you in the form of inflation. And the inflation is eating up our dollar. That's why what was once $1, you know, becomes 70 cents later, 50 cents later, because it's not invested and it's not keeping up with the rate of inflation. And that's essentially what our money is doing in our checking and savings accounts. So I'm not saying to skip your savings, okay? I'm not saying to not pay your rent to start investing. But what I'm saying is that if you know you need to start investing, if you have a couple of $100, you know, that you need to put to work, that's just sitting in your savings account, then baby, it's time to put it to work. And if you need help with getting started, okay, that is exactly why I created the Invest Your First $100 live workshop, y'all. The first part of the workshop, to be clear, is dedicated to accounts, including Roth IRAs. I'll break down in more detail tax advantage accounts versus non-tax advantage accounts, so you understand which accounts make the most sense for you, okay? And then we actually open the account. I'll give you a step-by-step video guide to open the account, and then of course on the live workshop, we are investing your first $100 together. It's a small group. It's your account, okay? I don't have no access to it. It's your $100. It's your bank account that you're moving that $100 into your Roth IRA in, okay? It's no guessing. It's no wondering if this is going to make a good investment. You will see my research process. You will see my Roth IRA. See what I'm invested in. See where I went wrong. See the mistakes that I made, but also see my gains and ask me questions in real time, you know? Dive in. So I want to just remind everybody that this is I'm working towards that, but I think for all beginners and people that are new, like you should really lean into tax-friendly, non-taxable accounts. So 401ks, 403bs, 457s. These are the most common company sponsored, government sponsored retirement accounts. I love them because they allow you to essentially get a match. Everybody does not offer a match, but let's say your company offers a 50%, they'll contribute 50% of whatever you put in there, So if you put $100 in there and they match you up to 50%, then that's $50. And again, I think a lot of times people feel like they don't have access to that money once they leave that company, and you do. Like, I'm in the process right now of rolling over an old 401k from my last job to Fidelity, which is where the rest of my accounts are. So I'll walk you through why I invested and what I invested in. Market returns 7 to 10% in growth every single year. Does that mean it's going to return that every single year? No. Will it return more some years? Yes. What you invest in matters. Absolute variety of companies, a basket of investments, if you will, for one purchase price, So it gives you access into multiple companies. So normally you'll hear people say, oh, I own all these Apple stocks, all these Amazon stocks. Great for you. However, if Apple has a bad day, which they really do, but if they have a bad day, you gonna feel that, and it's gonna throw off your whole day. For me, I prefer to buy ETFs, index funds, because I like my money being in multiple places at once for one purchase price. It's not like I have to go out and buy every one of these individually. I don't have to track everything that they're doing. We can look at this list, and we're probably familiar with 7 out of these 10 companies. We probably use them every single day in some way. NVIDIA's behind all this AI stuff. Microsoft, Apple, Amazon, Meta, which is Instagram, Facebook, Tesla, like all these things are pretty familiar to us. So it's not something that we don't understand. And so having your money across multiple places helps for diversifying. So if Apple does have a bad day, Amazon probably didn't, Meta didn't, NVIDIA didn't. So it helps your money to still stay invested and not have, risk a big drop by just investing in one company. So why you'll love them, because this is where I started with, they are less risky than trying to pick individual stocks and just track their growth. I think there's room for that, but I feel like as a beginner, the best thing that I decided was to go this ETF route, because again, I like my money in different places working for me. I can't go all in on one company. That's too close to just having one income. No, we want multiple streams of income. So they also have lower cost than mutual funds, and mutual funds are essentially peace of mind. It'll just let you know that, like, even if there is a bad day, some companies can do really well and it can help balance your money and balance your portfolio, which is ultimately what we want. Okay, let's see what it becomes. Okay. Okay, cool. Okay, she said, I'm gonna shut down. Okay, cool. All right, that's fine. All right, next is sector ETF. So these don't track be paying anything outside of the expense ratio to own an ETF. And last, I think this is last, bonus is capital gains. And so I think a lot of people think of capital gains and they think of real estate, because I feel like the two go hand in. All right, let's go through my. Let me try this one. Yes, one at a time. One at a time. REITs ain't going nowhere. But yeah, REITs are good. I'm a huge fan. You can be loved, yeah. That is in your portfolio. So I know FCROX and FCILX is the most, but all of that is auto populated. So really all you need to do is make sure your ticker symbol is there. This for a little bit. I think I am still interested in knowing more about brokerage accounts too, and kind of the benefits of that. Okay. Reaching out, as well as, I think for me the goal is consistency, right? So figuring out how this can be a consistent lifestyle versus just a one-off. Yes. Yes. So no more wondering if you picked the right ETF, the right stock. We focused on one investment, which is ETFs. We're focused on $100, and we're focused on one account in that workshop, y'all. I want to give you a clear starting point, a simple point, because you've done enough research. You've thought about it enough, okay? You've read enough books. You've saved enough posts. It's time to take action. I always say this, investing is not a spectator sport. just like you learn new skills on your job, just like you learn how to become a parent, okay? Just like you learn how to be a wife, okay? Same thing here. You have to get into the game. You have to get into the game, and I'm giving you a simple, small, $100 ain't gonna kill you, baby. A simple and small starting point, okay? And then you're gonna have a clear process of investing that same $100 for the rest of 2026. And so again, this is happening on Saturday, March 28th. It is live and in color, okay? On Zoom. It's a virtual workshop, so no matter where you are in the US, you can join, and spots are limited, y'all. Spots are going very quickly, and I love that for us, okay? Because the girls are getting serious about their money, and I love it. It's March. It's Women's History Month. So if you've been consuming that content, but you haven't taken action yet, this is your sign to take action, baby. And if you're going to start this year, this is the moment to do it. So the link is in the description, and grab your spot before doors close, which is on March 23rd. So I'm looking forward to seeing you in there, okay? So now that you are excited about investing, it is time to make room, okay? In your life and in your budget to do it consistently. It's not enough for me as a money coach, as your money bestie, to just have you put that $100 in there and never do it again. No, I want this to be a consistent thing, which is why we have to really assess and analyze how our spending is happening from month after month, year after year. And in my next video, I'm actually highlighting everything you need to know about money, investing, all the things in 15 minutes, y'all. Consider this like a crash course of all things money that we should have learned in school, y'all. But I learned this over the course of 38 years of living, baby. So again, it's a little crash course that you wish you would have saw a lot sooner, okay? But it's some hard lessons I had to learn that I hope you don't have to learn in return. So click somewhere on the screen. It'll be popping up on the screen somewhere. Go ahead and click that, and I'll see you over there.